construction costs, they're not coming down. They're staying steady, but they're not coming down. And we still feel very confident in the long-term trajectory of the springs down here and this project. It's actually an opportunity zone deal as well. So there's a huge incentivization to hold the project for 10 years to help alleviate investors' taxes. We're looking at this thing on a long-term, 10-year hold basis.
What's up, Colorado? Chris Lopez here, and we are bringing back another deal analysis show. So today, we're going to be looking at some ground-up construction for a multifamily building in Colorado Springs at just under 200 units. So we're going to dissect a real deal to understand market trends, the opportunity, and how development works. So I've got Adam Fenton with Narrate back in the studio, who was here a few episodes ago talking about a ground-up construction here in Denver. I learned a lot, and we also got amazing feedback from the audience. And Adam offered to come in here and drink some more coffee and talk about more deals. Good morning, Adam.
Hey, good morning, Chris. Thanks for having me back.
Yeah, I'm always really excited to come and talk deals, especially as the market has shifted. We've talked about a lot of times, the opportunities now in these bigger deals in the commercial space, and so much opportunity in the development landscape as well. Now, we're going to talk about a specific deal that Narrate has called Canopy. And we'll give a quick disclaimer. This is a real deal that Narrate is putting together, but we're using this to help educate people on the landscape of the market and how deals are. This is not a solicitation for investment. That comes in a different information, but Adam was nice enough so we could pull up the OM to actually go through the details here. So Adam, in your own words, give us a few sentences about the Canopy deal in Colorado Springs.
Yeah, so the Canopy deal in Colorado Springs is a project we've been working on for some time now. And, just as you stated, 192 units here. And so it'll be no parking below grade. Everything is above grade to help keep costs as low as possible. Love the south end of downtown and what Colorado Springs is doing to really bring in great restaurants. A lot of new multifamily down here as well. A lot of street improvements, alley improvements. The city's really getting behind development downtown. And when we had an opportunity to purchase this site located at 428 South Nevada, was something we had to do.
Going into the market first, because that's always like kind of start big picture. Why Colorado Springs?
Colorado Springs is a market that we've had on our radar for quite some time, and it's really just about the positive momentum that is going on down there. There's other cities that have become more challenging to develop in. They're very, very pro-development down there and will do about anything they can to help your project succeed. And we love the long-term growth projection that Colorado Springs is on as well. The city is really putting money behind this initiative to become, kind of the outdoor mecca of the U.S. So you have the mountains right there. And then also just with all of the defense and new companies continuing to move here, it's a market that we like. Definitely in the long term. Short term, there might be a little bit of softness down there, but long term, we're huge believers.
Yeah, it's a very robust and diversified economy, and I like how you said like positive momentum. I feel like core Colorado Springs is positively growing. We're like core Denver is kind of trending in the opposite direction.
Yep.
And yeah, what Springs is doing, plus with the soccer stadium down there and a lot of the growth, it is a really, really, I think, a great opportunity to like where Springs is headed in the long term.
Yep. 100% agree with that.
All right. So talk to us about, and I'm flipping on screens here so you can tell me if I'm on the right slide for you or not. Okay. So walk us back to the project details on here. You got this land. What is currently there, and how did you find this property?
Yeah, so it's a great question. This was back in 2021. We were experiencing some challenges with getting approvals and permits and all of those things in Denver. So we as a company started to look outside of Denver and the surrounding MSA. We were looking out of state. Colorado Springs really was not on our radar. And you just keep hearing it over and over again. So finally talked to someone who I really respect. And they said, just do your research, take the time. I think you'll be surprised at what you find. So we did that and came back and said, I think there's a real opportunity here. There's some new projects that got built that were just doing really, really well. So at that point in time, we were actually interested in a property. We had a connection to the owner there at 421 South Tejon, which actually ended up being a project we ended up buying later. But 421 South Tejon was the one we were interested in. It was not for sale at the time. There was a current tenant in one of the buildings that had a long-term lease. So in talking to the owner, he said, "Hey, I own this site across the street, though. 428 South Nevada, it was about at that time a 27,000 square foot site." He said, "Are you interested? Would you potentially be interested in this?" So long story short, we did end up getting under contract and ultimately ended up closing it in 2022.
Okay.
So it was, I think, July 1st of 2022. What is on the site currently is the Bench restaurant, which has been vacated. And then there was a used car dealership on the corner that has also vacated the premise. So two buildings on the site, but definitely highest and best use is new development here on the corner.
All right. So both are now vacant.
Both are now vacant. Yeah.
Okay.
Yep.
And so this is actually the same owner as the other property.
That's correct. Yeah.
Wow.
Yep.
Is that pretty common that, hey, you talk to them about one deal and then another deal pops out?
That happens quite often.
Yeah.
You just never know the things that people own that you have no idea. And we had no idea he owned across the alley as well. And we see that quite often, where you go in thinking it's one thing and then you come out and it ends up being something different when it's all said and done.
So is this like a direct owner contact, or are we doing this through a broker?
No brokers were involved in this. So this was direct owner. My partner, Zach, knew one of the gentlemen that was in the ownership group for the 421 South Tejon project.
So good old fashioned networking, huh?
Good old fashioned networking. It's still alive.
Okay. Could you walk us through just like the high level numbers and like the big picture of kind of the cost of what it takes to put a big deal together like this? And we'll dive into some more of the timeline.
Sure. So as you can see on the screen, 192 units. I will say that will ebb and flow a little bit as we continue to go through design. It could be a little less, it could be a little more, but generally speaking, it's going to be right around this number. We're anticipating a groundbreaking in the first quarter of next year, probably March to April, I would say, is a point in time where we'll be ready to kick this thing off. Total costs are 45, just over, or I guess almost 46 million, 45.8 million. It does seem like a big number. But it's just one of those things where construction costs, they're not coming down. They're staying steady, but they're not coming down, and we still feel very confident in the long-term trajectory of the springs down here and this project. So we're completely behind it, and this will be it's actually an opportunity zone deal as well. So there's a huge incentivization to hold the project for 10 years to help alleviate investors' taxes. So we're looking at this thing on a long-term 10-year hold basis.
Now, we won't get all the details of opportunity zones, but they are a great way to help. You can do a 1031 with real estate or sell other assets.
That's correct.
Stock assets, business assets, roll them into an opportunity zone and not have to pay a lot of capital gains on the money in, right?
That's correct. Yeah. So there's different step-ups throughout the 10-year hold. You'd probably need to bring an accountant or someone way smarter than me.
You absolutely need to bring an accountant. We're talking
to explain that. But generally speaking, if you and this was back in, I think, 2016. Trump did this when he was president, and what they did was the federal government laid out areas where they wanted to see investment in real estate. So they designated opportunity zones throughout the entire U.S. So essentially, if you are an investor in one of these opportunity zones and you follow all of the rules, you can roll those sale proceeds in, and if you hold it for 10 years, you pay no taxes. So it's a pretty good tool for that. Trying to build wealth and defer, probably at least 20% if you're in the capital, if you're a capital gains rate. So
yeah. All right. And then, so over the 10 years, walk us through like the very high level timeline, if you don't mind.
Yeah. So really, over the timeline, it's, we've got in here an 18-month build. So we have approximately 12 months of entitlements. So when I say entitlements, that's kind of a dual path thing. And one is going to be a development plan. So you have to get a development plan approved with the county down there and the city. And what that does, that just really lines out all your, how tall the building can be, how far back your setbacks are from the street, how much transparency you have at the ground level, what is the overall height of your building, and it also gets into transportation quite a lot as well. So this is, but it's a smaller document. It's about 20 pages. That is one thing that when I say entitlements, you have to get that approved. In addition to that, you have to be able to get the building permits as well. So it's really kind of a two-track system as you're going through your pre-construction and entitlement process.
And so do you start all of this after you go under contract? Is it before you're going to, this is something I've always been curious about development because there is, a long timeline, a lot of due diligence.
Yep, that's right.
And how do you balance hey, we're going to invest a lot of money up front before you even secure the property, know if it's a go or no go? How does that work, and how do you account for that?
Yeah, that's a great question. We would prefer to just be under contract and get all of this approved without having to actually pay for the land. In that scenario, yes, you have out-of-pocket costs that let's say you don't end up closing, you have out-of-pocket costs, but you don't have the out-of-pocket costs of the land. So when the market was hot, though, you didn't get that time. So, typically Denver, Colorado Springs, if you wanted a deal, you had to move pretty quick. So typically what we're doing, and I actually have a whole kind of presentation I put together that maybe we can go through on one of the other episodes here, of how to buy land. How, from the time that you identify it till the time you close on it, what does that process look like in between? But in the scenario we were in, we were having to go under contract for, you go under contract, you'd have maybe 30 to 45 days of due diligence. So, with money still refundable at that point in time. And then after that 45 to 60 days, you're going non-refundable. And typically we were closing, I'd say 30 days after that. So within 90 days, we were buying a land and not even really knowing what we can build. We will mass this out with the architect. We generally know what's there, but there is a risk to that, something could be missed or something like that. But generally speaking, that's how, all the deals we've done so far, we've had to do. We didn't get to tie the land up and then go through this really long process while we're under contract. We were having to buy the land and close and carry the land.
Okay. Now, how, when you do the site development plan, the entitlements, how much of that cost, just ballpark?
Depends on the size of the project and the type of product. On a deal this size, you're looking at entitlement costs of probably close to $1.5 million to $2 million, I'd say.
Okay, so that's real money.
It's real money, yeah. This is real money, and that's mostly just to your consultants, right? That's your architects, interior designer, mechanical, electrical, plumbing engineers, landscape architect. It's not cheap.
Okay, so looking at the timeline here, it sounds like by the end of the year to have. Yeah, everything wrapped up?
Not quite. So if we're looking at the screen here, the DD pricing, that's design development. So as you go through the process, you can see on the screen up there, it's kind of a progression. So you've got concept design. So that's very high level. Generally speaking, big box, not a lot of detail to it at that point in time. Then you go to schematic design, where you start adding more details. You start identifying major building systems, for HVAC, electrical, all those things. You're defining that during that process. Once that's done, then you go to design development, which is just more detail. And then finally, construction documents, which that's the documents that are actually built off of.
And that's what the CDs. That's what stands for. Okay, for construction documents.
So that's really being able to, it's everything from the type of tile that you're going to put in, to the shower pan you're going to put in, to the brick you're going to use on the outside, to the windows you're going to use. It's a very It's a big document, and essentially you just kind of keep building. You keep building as you go through the process and adding more detail at each stop.
I kind of view it as like peeling back an onion.
That's
you just
right.
kind of keep peeling back a layer and get deeper and deeper.
Keep peeling it back. And then the other thing we do is we'll work with a general contractor always. So at initial concept, we'll typically there is enough detail there, and then we provide some narrative. So we'll take that to general contractors at that point in time. We don't do general contracting in-house. It's all third party. So we'll start working and talking with a general contractor during that concept phase or after the concept phase. And we'll pick someone to work with as we continue to go through the process of schematic design development, and construction documents.
Okay.
And the reason, and you can see it in here, we stop after each phase. We're adding detail to each phase. So we take a little pause after each phase to price it out, to make sure that our budget is still in alignment with what our expectation is.
Gotcha.
And if it's not, we actually pause at that point in time and look for ways to, get the budget back aligned.
Okay. And then it looks like you'll start demolition and construction in April 2025, right?
That's correct. Yeah.
Okay. So I guess I have this image of a wrecking ball coming down to knock down the building. Is that what happened? You demolish the buildings first?
Yep. Demolish the buildings first. That is the first things you have to do. Actually, the first thing you have to do is you have to cut off all the utilities and things.
Yeah.
Which we've chose not to do that quite yet. Although we did do some remediation. Just in case the project doesn't go forward, we don't want to totally cut all of our utilities off. In a case, kind of a one-off chance that we have to reuse these existing buildings.
Oh, so it says like a kind of a plan C or something.
Yep, that is right. So yeah, you kind of want to leave it in place as long as possible. So that's how we will treat that. So then once it's a sure go, then we go pick up our demolition permit, cap the utilities. So it's going to be your water, sewer, all of those things, and then disconnect the electrical from the building.
Okay.
First step in the process, and it's not quite a wrecking ball, but it is a huge, it is a huge piece of machinery out there it'll be no match for these buildings. Will be no match for that. That's for sure.
Yeah, one of my, I think, childhood dreams from my 9-year-old boy and me is to go take one of those wrecking balls and whack it one day.
Say if you want to come down and sit in the cab, you can operate it, man.
I got this on recording. We might do that. Fulfilling my lifelong fantasies here. All right, so I think you said it's usually about 18 months from demolish to the tenants being able to move in.
Yep, that's correct. Yeah.
So April 2025 would put it into end of Q4 2026.
Q4 2026. Yep,
okay.
That's correct.
And then how long does it normally take to lease up a building of just under 200 units?
I think it really depends on, I think your location, product quality, all of those things. The staff that you have leasing the building for you is a huge thing as well. But I would say in this scenario, it's about 12 months. And some people are very occupancy driven. Some people are more rent driven. So it's kind of trying to find that right balance in between.
What are you more driven?
We're probably driven a little bit more by rate than we are occupancy, but you have to be careful because you don't want to continue to have operating shortfall, right? Which is when you don't have enough cash flow from your property to pay your expenses or the mortgage or anything like that. So you've got to, so it's kind of trying to find that right balance between those two things. So I would assume, I would hope that we're getting, 10, 8 to 10 leases a week would be ideal.
A week?
Yeah.
Wow. Okay.
Yeah. But, which in larger projects, that's a possibility. But we build in a much longer time frame than that, assuming that it's just going to take more. Yeah. I think we're just under 20 leases a month, I think is where we're at.
And that's just to be more like just plan conservative type attitude.
Yep. Plan conservative. Nothing ever goes according to plan in development. So we try to be as conservative in nature as we can when the time is right.
Okay. All right. So April 2025 construction starts. December 26 leasing starts, and then with about a year should be fully leased up and stabilized.
Yep.
What happens then?
So at that point in time, we really go into stabilization and asset management mode at that point in time. So that's working closely with our operations team, ensuring we'll have leases that start turning and those type of things. So try to get very smart about what our rollover looks like. We don't want all the leases to expire in the same month.
Yep.
That'd be so really hard to lease up the second year. So you're kind of trying to sequence everything correctly, that you don't get left with an empty building when it comes time to renewals. And our goal is obviously to have everyone renew. I think we're at 65 or 70% across our portfolio right now on our new development. So I think that's probably a testament to our team on site, and then also our
if
building.
Everyone renews, that probably means your rent's too low then, right?
Yeah, that is true as well.
So is that 60? Is that kind of like the healthy sweet spot for like renewal and a little bit of churn?
Yeah. Yep.
Okay.
Yep. That's right. Yep. So that's it's kind of trying to find that right balance again of but we're in an environment right now where we're I think at 3% on renewals right now. So we're trying to or flat.
A 3% rent bump.
Yeah, that's correct. Yeah, 3% rent bump on renewal. But
wow, that's stronger than market average now.
It's definitely stronger than market average, but we're not willing to watch our occupancy crater either. So we have a close eye on that. But so far so good.
And is the plan, because I know last time you were in here, you had just closed on a property management company.
Yep.
Is the plan for you guys to manage this in-house from the PM, or is that staying more Denver focused, or is that all just depends over the next couple of years as things go?
It's a good question. I would say more than likely this will be a third party managed deal. The company that we bought is geared more towards smaller, more Class C type properties right now.
Okay.
And I think we'd mentioned maybe looking at, some way to get to a boutique management firm. But this project's large enough that it can have its own on-site dedicated staff. So in that scenario, we're probably going to go with a third-party manager here.
And for turn units, you can get some of the great PMs down there too.
Yeah, that's right.
To manage it and do well.
Yep, that's right.
All right, now last couple questions on here, because I know we're getting close to the end of it. I want to kind of talk about just the total equity and the debt structure and the timing of it, because like I've done a lot of like as a GP and LP, I've done a lot of stuff in like multifamily value add, and I have a good like framework for LTVs and timing of capital.
Yep.
But when you're bringing capital in here for development projects, like what do you bring in now? What do you bring in later? And what's the refinance look like?
Yep. Okay. I will start with what does it look like now? So right now,
and keep it simple, stupid for me.
Okay, I will keep.
This is new. I'm still getting a good handle on this.
Yeah. And it can get you can get very complicated when you start getting into joint venture structures and things like that. We underwrite it assuming fairly simple ownership structure here. So right now, there is how we have set it up. There really is no LP and GP, two separate investment vehicles here. So when we're buying land and entitling land, everyone is treated the same. And investors in the land with us right now are getting an accrued preferred return on their money. So then once, does that make sense? I guess.
Yeah. So kind of just keep it simple.
Keep it simple. Yep. So you invest, you get a 12%. Right now, you get a 12% return. We're not paying it current. It continues to accrue until we close on the financing for the vertical construction. So, Chris, if you were an investor with us in this project right now, we would come to you when we're ready to go vertical. We're ready to build the project. We're going to say, Chris, do you want to stay in or are you out? So you have some flexibility there. So you're not, if you say, hey, we're going to invest in the land with you, you're not tying your capital up for the next, 3 years, 4 years, 5 years. You have the opportunity before it goes vertical to potentially get your investment back plus the return that you made during that time frame of pre-development.
Okay. So I could cash out and that'd just be based on the 12% accrued return.
Yep.
Or I could, I presume, roll it into the vertical phase.
That's correct. Yep.
Okay.
Or you can roll it in and have the investment, for the next, 10 years potentially here, just because of the opportunity zone.
And then that would include the preferred return plus
that's right.
the upside.
Yep. That's right.
On the performance, right?
That's right. Yep.
Okay.
Yep.
And then what's the kind of rough numbers for because I believe it's a lot less equity now.
Yep.
And then what kind of rough percentage, total cost, is it, how much equity do you raise in the first phase versus the second? And then what's the debt look like?
Yeah. Good. That's a good question. So we're at about 35% total equity on the stuff we do. We tend to not over leverage on our projects. Today it is a little harder to get to that 65% because interest rates are high, which means you're going to have a debt service coverage ratio issue if you push leverage too much. So there are ways, I'd say traditional banks today, if they're in the game, they're coming with probably 50 to 60% leverage in today's market, is kind of what I'm hearing out there right now. Which we prefer to be a little higher at 65. So we would look at, probably not mezz debt, not a huge fan of that. They can get a little predatory sometimes.
Yeah.
So, what I would, so we would look at like a PACE financing here, a PACE financing option, which it's kind of like mezz debt, but less expensive.
Okay.
At the end of the day,
and they have less control over.
Yep, that's
the destiny of the project.
That's correct. Yeah, I mean, they're just kind of along for the ride. It's actually an energy thing that we could spend a whole probably podcast talking about CPACE financing. That'll be for another day.
That's on the list as well.
Yes. So, but yeah, that's so typical capital structure looks like 35% equity, 65% debt, and then of the within that 35% equity. On a deal like this, we most likely will have one large investor. That's typically how we've done our developments. One large investor that's going to take 90% of that,
like an
that equity.
Or family office.
Yeah, family office, institution, high net worth individual. We've got a couple of folks that invest with us that are high net worth. So it's really kind of just about who wants to invest and who has capital they want to put out at that point in time. And it's definitely less than it was 2 years ago right now. So that component has become more challenging, I would say. But there is dry powder out there, and I think if you have a deal that makes a lot of sense, you can still raise the capital for it.
Yeah, I mean, I've looked into this deal and the Tejon deal, and man, they both look like super attractive, like just from the deals, and also like I really like the Springs market,
right,
as well.
Yep, exactly.
Okay. And then, all right, so last question here. So go vertical, call the remaining 65% or so of equity.
Yep.
And then you're in hopefully a 65% LTV loan.
That's correct.
And then from there, is it just hold for next 8 years, or there's some cash out refis?
Yeah, good. Yep. It really depends upon the structure that you put in place from a debt perspective. In the past, we've actually not refinanced. We had these great loans that were construction to perm loans. They were 10 years, and we were able to fix our interest rate for the first 8 years. That product is not available today.
Okay.
It's just, banks are on the sidelines. So this is probably more it's one of two ways probably here. So you go more traditional route where you go with a bank for the construction financing. Then you probably at stabilization, you'd probably look at bringing cashing it out and bringing a Fannie or Freddie loan in to take it out. That could be one way. But another product out there that I've done in the past that is available from some insurance companies right now it's called a participating mortgage. So essentially the insurance company provides you debt, but is almost treated, but then has some equity characteristics to the agreement of share of cash flow and things like that.
Really?
So that's a product that is out there right now. We were just chatting with some folks a couple debt brokers.
Is that a newer product because of the higher interest rate environment?
Yeah. Yep. It is I actually have done a couple of these. I did them coming out of the Great Recession. It's a product that's back and available now. So that's something we'll consider as well.
Okay. And then what's the exit strategy on here? Because you mentioned 10-year hold, and also aligns with the opportunity zone on here.
Yep.
So, is it just sell the whole building off at the 10-year mark?
Yeah, I think that's what we definitely that's our first, we'll call it A on the business plan, but we have to be prepared, if we get some great offer, something like that, we can definitely pivot and be fairly flexible here. And a lot of it's at the end of the day is going to be driven by who our large equity partner is. They're going to want some say and some control in that.
Yeah. Okay, so if you get a crazy offer before then, might take it.
Yep.
Otherwise, sell around the 10-year mark.
Yep.
And then I guess is like one of the plan Bs or Cs if depending on market conditions, then just hold and flip the coupons.
Yep, that's right. Yep. It's once it hits stabilization and we're into the stabilized loan portion, whether it be a refinance with Fannie or Freddie or some other loan. It's really just maximizing NOI and cash flow going forward. So we'll hire a great property management team. We'll asset manage closely hand in hand with them, and just try to create as much cash flow for our investors over that time frame.
Fantastic. Adam, thank you so much.
Thank you
for coming in the studio.
I appreciate it.
I always enjoy learning from you, looking at the deals. And listeners and viewers out there, if you guys want to learn more about deals like this, let me know. We are putting together more deals with Narrate, and there's some really cool opportunities out there, especially as the market is shifting.
Yep.
There are a lot of opportunities in these bigger deals with like the partnership and syndication structures. It's a really exciting opportunity out there, and I'd love to talk more about it. And we're going to have to come back on to not just talk more deals, but talk about the C-PACE financing.
Yep.
And also, I want to see your presentation on how to buy land and develop.
Alrighty. That sounds great. Well, I look forward to the next session, and I really appreciate the time today.
Awesome. Thank you, Adam.
Thank you.
Bye, everyone.